and welcome to Small Business Snippets, the podcast from smallbusiness.co.uk. I'm your host, Anna Jordan. Today we have Nicola Horlick, an entrepreneur and investment manager with over 30 years of experience. She's the CEO of P2P business investment firm Money&Co, and as such, we'll be talking about business finance. Hello, Nicola.
Hi.
How are you doing?
Very well, thanks.
Great. First, I'd like to ask a bit more about you moving from finance. How is it becoming an entrepreneur for the first time, having worked in that industry for quite a while?
Yeah, well, I worked originally for big banks, and I was really lucky. I started at a very successful bank that was growing really strongly. And then after that, I went to another bank which had a very major problem with one of its businesses, and I was hired to turn it around. And then I went to the French bank, SocGen, and they asked me to set up a fund management business for them literally from scratch. So it was just me, a Frenchman and a secretary on day one. And that sort of naturally took me to the point of saying, I really need to do something on my own now. Because I'd sort of done everything within the banking environment. Mm-hmm. And having set up a business literally from scratch, it then gave me the bug, so to speak. Yeah. And so the next step after that was to set up a fund management business with no big bank, just me, and getting some backers. So I did that, I set it up in 2004, and it was approved in 2005 by the FCA. So that was Brandine Asset Management. I've set up numerous different businesses since then, mostly around finance. So in 2011, I set up a private equity business called Rockpool with two guys who are both ex-3i. I then also set up some film finance businesses, and also I got involved in the music industry, and I listed a vehicle on the London Stock Exchange to invest in alternative investments. And then I've done less successful things like setting up a restaurant, which was a very, very bad idea, and I'm still trying to extricate myself from that now. But, it's led me to a different world, really. And then ultimately, I set up Money&Co in 2013, and Money&Co is a peer-to-peer business lending platform, so it's individuals who want a better rate of interest on their cash, lending to businesses to help them grow. Our bad debt experience to date has only been 0.04% per annum. We've only actually had one bad debt in 5 years. And so with this, it's not that necessarily that we're unique in that there are other companies, obviously, Funding Circle's massive, that lend to small businesses, that we take a more considered approach. And it's mainly because I am a fund manager, I've been an investor for so long, whereas a lot of the people running these businesses come from different backgrounds. They might come from tech or marketing backgrounds rather than money management backgrounds.
What kind of criteria do you look for in the businesses that you want to invest in?
So we have some very basic requirements, like you must have 3 years of filed accounts, the company must have been profitable in the last year of operation, and it needs to demonstrate to us that it's affordable for them to borrow.
I'd like to talk a bit about the peer-to-peer lending market. On the retail side, the FCA bringing in tighter lending rules for retail investors after the collapse of lending. How is this affecting the business investment side, and how do you think it's going to affect the industry as a whole?
Well, as far as I'm concerned, it's a very good thing, because when it all started, it was what's called light touch regulation, so there weren't that many rules. And it did concern me that there were people running these businesses who often didn't have a financial services background, and I'm not sure that's the right thing for the lenders. And the lenders are largely retail clients, and a lot of them are older as well, and they're looking for income. And so it's really important to protect them as much as you can. So I actually welcome the new regime that's going to be introduced on the 9th of December by the FCA, which is going to tighten up on all this stuff, because it's hopefully going to mean that the right people are lending, and that the people who are doing the lending on their behalf are better qualified to do that, and that their money is going to be better protected.
So Money&Co, as far as you can see, will always exist as a P2P lender?
Yes.
Never bring in other products?
Well, we could, but that might confuse people. I think it's better to focus on that, because there are huge opportunities in lending. My own background is very much an equity background. So I'm relatively new to lending. I've only been doing it for 5 years out of 36 years of being in financial services. So I'm a relative novice. But there are huge areas of lending which you can bring into the P2P arena. So for example, leasing is an absolutely vast industry. There's 100 billion a year of leasing contracts in this country, 25 billion of which is business critical leasing. So that's the printing press for the printing company, or the trucks for the trucking company, or the dental suite for the dentist, things that those businesses absolutely cannot do without. There is no reason why you can't put those into a P2P environment, those types of loans. So and house building is a very good example of where banks are reluctant to lend. There's a shortage of housing in this country, and there's no reason why we can't devise a product, and in fact we are in the middle of doing just that for that industry to help them build more houses. And that's then taken us to the point of thinking, well, prefab has never really properly taken off in this country. It's much more of a thing in countries like Germany and Austria. But actually, that's a way of building houses a lot faster, and also making them much more eco-friendly, because you can insulate them in the factory and you can put the houses up in a couple of weeks, and you can fast track the build, so that instead of having men sitting in the rain putting one brick on top of another, which is crazy in this day and age, you can make them in a factory and then assemble them really fast. And you can also create much more interesting developments architecturally if you do that as well, because it's a bit like Lego. You can have all different shapes and you can make it much more interesting. So we're looking at ways of raising money from institutions to actually fund house builders. Now these will still in effect be P2P loans, but it'll be an institution lending to a house builder rather than an individual lending to a house builder.
Coming back to you as a business owner, I understand that Money&Co has suffered quite a financial loss, but you have said that there'll be substantial profit going into March 2020. So what are your recovery plans, and how do you
this is a sort of typical Daily Mail story. If you actually look at how much money we've lost in the last 5 years and compare that to Funding Circle, it's a fraction of the amount. The Funding Circle in 2018 lost £50 million in 1 year. And Money&Co has made very small losses relative to Funding Circle. But my aim is to make the business profitable as soon as possible, because I don't really believe in building businesses that just go on making losses and losses and losses. And we could have lent an awful lot more money if we burned more money, but that's not our approach. So our approach is to build it in a very steady way. And yes, I do expect to make a profit. Well, it's certainly break even in the year to 2020. In fact, we may not, because it depends very much on how much we spend on marketing. And, if we really want to accelerate the growth of the business, we may decide we want to spend more on marketing. If we spent less, we could make a profit. If we spent more, we're going to end up with a bigger business the year after. So, it's a fine line.
How do you make that decision then of whether the marketing is worth it?
Well, just before I spoke to you, we were having a meeting about that and just going through our marketing strategy and trying to decide how much we should spend. It's quite formulaic, really. We sort of know, of course, we've got this problem, not really a problem, but we've got the fact that the FCA is tightening up all the rules, which makes direct consumer marketing a little bit more complex than it was previously. But it's a bit binary. If you spend this amount of money on Google in its various forms, you're likely to get a certain number of clients. And so it's really a matter of how much we want to put into the hopper and how much we're going to get out at the other end. And also, how many loans have we got that we think need to be funded. But, assuming that we are able to get the institutional money that I think we can get to help us fund house builders, we certainly should be at break even, probably make a profit in the year to March 2020. But I don't make any apology for having made losses. It's a start-up fintech business. That's what fintech businesses do, make losses.
So how was it when you started up is it 2013, correct?
Yeah, so the company was formed in 2013 and then we launched the business in 2014, April. Yeah. The site went live and we completed the first loan in July 2014.
Right, okay, great. Normally with a startup company, it's usually the first year or so, or a bit crackly, but it starts to even out a little bit after that.
Well, in terms of profitability?
Yeah.
Yeah, we're not in fintech. If you look at all of the people that are running fintech businesses who've been running them over the last few years, you'll see that they've all made big losses. So, it's sort of accepted that when it's a new industry, you've got to establish the industry and you have to throw money at it in order to create it.
Yeah.
It's not like setting up, a shop. Well, actually, shops are a pretty bad example because they're not very easy to do these days.
Yeah.
But, there are more traditional businesses where somebody might have, been working for an engineering company and then sets up on their own. Usually the rule of thumb is that the business should move into profit in year 3, in its 3rd full year of operation. That's what I would normally expect. But, with this, there's a discretionary element to it, which is the marketing spend. We could just run a business that's profitable and keep it small. Or we could decide that we want to make it a lot bigger, but in order to do that, you have to spend a lot of money on marketing.
What do you think about the state of business in the UK, especially in the light of Brexit?
No one seems to have noticed that the economy has slowed down very significantly. And we do see it because although, a lot of our loans are property-backed loans, we do have some engineering businesses, for example, that we've lent to that are beginning to see a slowdown.
Right.
And that is Brexit related in that uncertainty means that people don't make decisions. So businesses have not been investing because they don't know what's going to happen. And there is evidence that car manufacturing companies, for example, are beginning to move things out of the UK. And the number of cars that have been manufactured in the UK is down 20% so far this year on the same time last year. These things are beginning to impact on the economy. They will have knock-on effects to all of the businesses that we lend to, which is another reason for being very cautious and one of the reasons why I have been so cautious about growing our book. But I have found generally during my investing life that I make a lot more money in bad times than in good. Because in good times, any fool can make money in good times because everything's going up. In bad times, your skill comes into play. And it sounds a bit counterintuitive, but I'm likely to be lending a lot more money in a recession than I am when things are booming because I will be taking on less risky loans.
Sure.
But it's just that lenders tend to withdraw. They react to recessionary conditions. The banks react. They actually lend less during recessions. So during a recession, there are more opportunities for the people who have money to lend. For I expect there to be a recession, and I expect to build the loan book faster, rather strangely, than I was when things were going really well. Because when things were going really well, you had funding circle throwing money at these borrowers, you had banks, you had international banks, you had vast amounts of money sloshing around, you had quantitative easing, lots of money being printed. If you print it, you've got to do something with it. All of that will come to an end, and it'll be much harder for borrowers to find lenders, and that provides us with an opportunity, and it means we're likely to find better quality borrowers during that period of time.
And one last thing I'd like to talk about. So you say that Georgina's, the restaurant that you used to run, went bust. With that in mind, what are the toughest lessons that you've learned as an entrepreneur? Yeah,
well, it's not quite true to say it went bust. What we did was we closed it down and then we moved to a different location. Although it wasn't called Georgina's, we called it the Walrus Room, and it was in Battersea Rise. It's more a bar with food rather than a restaurant, which, and we've just got a new manager to come and manage it. So I'm still involved in it, but it's a nightmare industry, and I absolutely would not recommend that anybody should ever go into restaurants. I think it only works if you are a really talented chef and it's your restaurant, or if you're Pizza Express. And anything in between doesn't work. So just a vanity thing where you open a restaurant because you like the idea of owning a restaurant, that's a very, very bad idea. And
so what are the toughest parts of running it?
Well, the costs are just ridiculous. I mean, the rents on the high street are still ridiculously high. So a unit like Georgina's, the original unit, the annual rent was $65,000 a year. The council tax was $28,000 a year. I mean, it's outrageous. I mean, $28,000 a year. Then 1/6 of your turnover goes to the VAT man. So everything you sell, 1/6 goes to the VAT man. Plus, we had to have 14 employees because it was a full-service restaurant, so we had to pay 13.8% of the wage bill in national insurance. So you're basically in business to pay tax and rent. That's basically it. And the idea that you're going to make a profit, unless you've got some really big-name chef behind it, it's pretty much impossible, in my view.
And finally, coming slightly back to my first question, what tips do you have for entrepreneurs or want to be entrepreneurs who are going from working full-time into starting their own business for the first time?
Right, so you need to make sure you've got some proper funding.
Yeah.
And a lot of people end up funding businesses through credit card debt or getting loans from loan sharks. I mean, that's just absolutely not the way to do it. The Seed Enterprise Investment Scheme is a very, very good thing because it allows you to raise £150,000 and the people who invest can get 50% of what they, as long as they're UK taxpayers, can get 50% of their investment back from HMRC. And so I think people need to put in the work at the beginning to make sure they've raised the money before they actually start the business. And they shouldn't be putting their life savings at risk, and they shouldn't be borrowing money on credit cards or going to loan sharks. It's really important to make sure the business is properly financed from day one.
Great. Well, thanks ever so much for coming on the show, Nicola.
Not at all.
You can find out more about Money&Co at moneyandco.com. You can also visit smallbusiness.co.uk for more on alternative investments. Remember to like us on Facebook at Small Business Experts and follow us on Twitter at Small Business UK, all lowercase. Until next time, thank you for listening.